update for you this morning. I've got a bank appointment here in just a little bit, so I'm gonna keep it really short and sweet today. I'm not gonna hit Forex. I'm not gonna hit crypto in depth. We're just gonna have a look quickly at the futures market, talk about what we're seeing from a bias perspective there, talk about key levels, and talk a little bit more about the bounce with a breakout strategy that we've been talking about over the course of this week. So with that said, let's go ahead and jump into it. I've got some stuff over here. Is the right one? Yeah. Yep, that's it. All right. So real quick, before I even get into this real quickly, crypto in both ETH and in Bitcoin, we've seen a really nice rally over the last couple of days. Really pushed higher. We talked a little bit about that over the course of this week as well. But Bitcoin is pushing back towards that 10,000 level. I mean, of course, we're at 96.40 right now, but nice rally from where we've been. ETH pushed up above 200 again, so that'll be a pretty key level for us to watch. Excuse me, over there on Ethereum. Let me see, maybe I can pull those up. Wow, here we go. Over on this screen right here. There we go. Yeah, so real quickly, Ethereum on a 4-hour, Bitcoin on a 4-hour. Let me just put my template back onto this so you can see where we are. We talked about the fact Bitcoin actually flipped on us and became a downward bias in the 4-hour, which, as I mentioned, I'm not really digging. We were looking at 192 as a potential selling entry point, but we also talked about yesterday, if we got a rally in Bitcoin, that it would pull this higher. I would personally prefer to keep looking for buy opportunities in most of these currencies, simply because I feel like as more turmoil occurs elsewhere in the market, that we could see money flowing into certain things, potentially metals, but also over here into our cryptocurrencies. So it'll be interesting to see what happens. And there's a lot going on in the crypto market. There's a ton of news happening every day. JP Morgan just partnered with just drew a blank. The Winklevoss twins, Gemini. JP Morgan just partnered with Gemini doing some crypto transactions. It'll never happen. Well, it just happened. You've got governments looking at potentially going into utilizing the blockchain and potentially even issuing cryptocurrencies. It's the classic case of look over here and I'm going to do this over here, out of sight. Yeah, there's a lot happening there, and I think we're going to see increased activity and increased interest over the time to come in our crypto world. So hard to want to short it, but there are opportunities, obviously, to short. I think if we stay up here on Ethereum, this 200 area will be another point for us. If we can stay above that 200, it'll be a big spot for us to potentially look at accumulating more around that level. Bitcoin overnight pushed up to a high of almost just a little over 9,900. So that's that's certainly interesting. 10,000 is the big whole number that's been the tough piece for it to crack. If we can crack through 10,000, that'll certainly be a big point for us to watch for Bitcoin continuing to increase from there. So, and as Bitcoin increases, often the other currencies follow suit. So that could certainly be something down the road for us. All right. So with that said, let's pop over here to the futures market. We've been talking a little bit. I don't know why I keep mumbling today. We've been talking about different trading styles. A couple of weeks ago, we talked about just a straight breakout, which I really love. I love breakout trading. I like breakout trading simply because it's super easy to set up and follow. Same with bounces. I mean, if you're patient And that's where bounces come into play. You've really got to be patient, waiting for areas for price to fall back to a key area, looking at the range, kind of top edge, bottom edge for a bounce, so on and so forth. But we talked about bounces in the previous week. This week we're talking about a combo of pullback and breakout. And let's get into that real quickly so I can keep this short for you and see if we can't keep it under under 20 minutes, which often is tough for me to do, but I'm gonna make a point of doing that today, keeping it under 20 minutes. So starting over here on the left-hand side, we have the S&P on a 4-hour bias. Remember, we'd been looking long yesterday. We mentioned the fact that the biases were mixed. The 4-hour, the 30-minute were mixed, so we didn't really want to look at the S&P because of that. Now, of course, I'm looking at a 4-hour and a 30-minute for my trading decisions. You might be looking at a 30-minute and a 15, or a 30-minute and a 5, or a 15 and a 1, or a 15 and a 5, or whatever it might be. There is no right answer to that. It just depends on what you are comfortable with doing and how active you want to be. Obviously, the slower the time frames that you're watching for key levels and for decision making and to form your bias, the higher that time frame, the fewer trades you're going to have, the fewer trading opportunities you're going to have, and the more time will pass between potential trading opportunities. If you're more active, then obviously you want to, as you go down in time frame, you're going to find more potential opportunities. Now, with that, potential opportunities, I'm going to reiterate, do not equal additional money in your account. There is very often a direct correlation between how much we trade and how much we lose. Because the more often we're making these decisions, the more often we're exposing ourselves to risk. And as we know, with anything, there's a series of losses and there's a series of wins, and you have that higher probability of a faster drawdown when you're trading more often. Not to say that there's anything wrong with it, just saying that that's where the shorter of a time frame that you get into, that's where the rubber meets the road. You've really got to have a dialed in process that you can follow consistently and is based on something that's quantifiable. I keep coming back to that term, quantifiable. That means something that's measurable. Your gut instinct is measurable. You can't measure your gut because it's going to be different every day. What you think is going to happen, or what you think should happen, or whatever your gut's telling you should happen or is going to happen, is going to be different every day based on how much sleep you got and what's happened to you the previous day and what's happened to you that morning since you got up, and so on and so forth. Quantifiable things are things that are definitively measurable. This and this and this happened, and now we're going to take an action. And that's where the filtering process comes in. So I use very simple filters. You do not have to have a ton of filters on your charts, but everything that you do, any indicator that you put on there is a filter, and how you use that indicator should have a definitive process behind it. If these certain things happen and the indicator goes to, if you're using Bollinger Bands and you're looking for maybe retracements off the I'm getting all stuttery. If we move to the top of the band, what do we want to do? Do we want to look for it to break out of that, or do we want to look for it to reverse? How do we make that decision? When do we make a trade? All of those things are based on the filtering process that you utilize for how you're looking at those specific indicators. Again, it comes back to, some people use tons of indicators on their charts. If you're using a lot of indicators and you're trying to look at that manually, you're going to create a situation where it's tough to digest what all is going on there. If you're using a lot of indicators, you probably need some sort of automation or an alert process that would say, hey, all of these things have just occurred, ding, 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 a bell happens, or a sound plays, or a light flashes, or whatever. The more indicators that you have, if you're trying to trade manually, you're going to get confused. There's more failure points, I guess is what I'm trying to say. There's more points of failure. There's more points of an opportunity where your human brain might go, 6 of those 8 things I'm looking for have happened, so I'm going to go ahead and take the trade this time. And then the next time it'll go, 5 of those 8 have happened, so I'm going to go ahead and take the trade this time. And you're not always really being patient and waiting for that full setup. So the more indicators you have, the more failure points you have, and the more opportunity you're leaving to deviate from your trading plan, right? So it's very, very, very important. You don't have to have a complex system. You just need to have a couple of filters that give you a way to approach the market in a quantifiable, consistent manner every single day. So I know that's been a long diatribe, but it needs to be said. And I know I sound like a broken record, but if you go to any trader that's out there, any trader that actually trades and is in this market and has done it for any length of time, you're going to hear the exact same story. Have a process, plan your trades for the day, consistency, 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 application, 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 application. It's just all about having a plan and being consistent in your execution of the plan. That's all it is. Our minds are what get us in the way of that, and again, I've mentioned before a couple of people that have really helped with mindset. Norman Hallett. I'm going to keep saying his name so you write it down and go visit his website or look him up, man. He's an amazing guy. I know him personally. I've known him for years. An amazing guy. His wife is an amazing woman. They have a great mindset training program for you. And I'm not even going to put in a link, an affiliate link. I'm just going to go there, seek him out. If you want help, he's a trader. He trades. He's a futures trader. He's a former broker, but he's been working on people's mindset for years now, because that's where we fail. And I say it all the time. I fail when I deviate from my plan. And I fail. I'm just like anybody else does. I had a winning day yesterday, but it was a failure because I deviated from my plan. I did things that I shouldn't have done. And, you can always say, well, I came out on top because experience, blah, blah, blah. But the reality is I deviated from my plan. And when you deviate from your plan, any success you have when you deviate from your plan should just be chalked up to luck, honestly, at that point, because you're not truly trading a system. All right, so I've been going longer than I should. Let's get back over to this. Let's talk about a system. Let's talk about a system. So what are we looking at? ES here, we're just starting to cross over. So my bias is starting to my 4-hour bias. Once this candle closes, looks like we'll be crossed here, and we'll confirm the 4-hour bias. Will confirm short. The 30-minute bias is short as well, and so we're short on the 30, and that will confirm the 4-hour short, so that we can start looking for potential selling opportunities. Now, what does that look like to us? If we're looking for selling opportunities, we want to look at one of two things. Either, we could look for a break of a key level, so we could look at previous lows and look for breakouts of those key levels, which we're kind of coming to now, or we could wait for price to make a little bit of a move, pull back a bit, and then get in short at a slightly better rate, right? So we could look for opportunities where maybe price floats back to a key level like 2,800. 2810 is the line that's been on our chart for a while here, but it's really a range. As I've said before, you've got, in this case, if we're looking for shorts, we've got a bottom edge and a top edge. So we'd be looking for it to come back to key areas that we could then sell off of. Now, in doing that though, how do we figure out where we're going to sell? Now, I've mentioned before, we've got just breakouts, or we might just look at a line on a chart and say if we break that level, we're going to sell it. Or we just look at a line and say if we pull back to this specific level, we're going to sell it. Well, the reality is there's other ways to approach that. And another way to look at that is with a combination of pullback and then break. And the combo would be something like this where, and let's just look at it yesterday, let's try to find a spot, make this bigger. Let's look at it like yesterday, for example. A combo strategy would be one where if we're in a down, and yesterday the biases were conflicting, so we really didn't want to look at the ES. But let's say we were, and we're basing it on our 30-minute downward bias. What we'd be watching for is price floating back up, and as price floats up, we're going to place a sell order at the bottom of that previously closed candle, right? So if we're looking for shorts, price is moving down. When it starts floating back up, we're going to start We're going to start placing our buy order, or dang it, reset my composure here. For looking for a downward trend, we're going to be looking at sells at the bottom of that previous candle and our stop loss at the top. Now, you don't want to trade during times when you've got low liquidity. We want to trade during times when we've actually got decent market volume. So, you can, if I added a volume indicator here at the bottom, you'd be able to see the times of day when you have more volume than others, and you can probably guess when that would be. It would be during the live trading hours, so you're going to see significantly more volume than others. But at any rate, what we'd be watching for is when price floats back up. So let's just pretend, looking at this, if we had that sort of a situation where we're trying to trail that entry point at the bottom of each of these candles, we might have an entry point here where we have an entry at the bottom of this, so we'd sell. So this candle closes, and we'd place a sell and a stop loss. Price might push down, touch us in, come back, and then move down, and that would be an opportunity for us to quickly take a 2-to-1, or maybe even you look for a 3-to-1 profit to risk ratio. Here we have when the market was just opening over here. We said we had some news yesterday. We're floating up, volume's increasing. We had higher lows. So if you're in a short situation, we're looking for higher lows, and higher highs as it's pulling up, right? And then we'd be simply trailing that entry point on the bottoms of those candles to look for short opportunities. And that's all there really is to it. It's a pretty simple system. It does not give you 100% winners. It does not work every time. It's actually one of those things that works well on most time frames here. The slower time frames, you're going to see more opportunity for those longer term moves, but also it's going to take longer for those setups to occur. But it's a very effective trading method. It's a very effective trading system. Just like anything else, when you apply it well. When you get into periods where price is chopping around, like we had the last couple of days, you see where you've got loss. So you've got to prepare for that. And that's where money management comes in. How much do we risk per trade? How much are we comfortable risking per trade? 1 or 2% is kind of that good rule of thumb. Some people might want to go higher, but just remember, and I'm not going to put it up for you. There's all kinds of charts on the internet that show you, risk to ruin and utilizing different percentages of risk and what that does to your ability to live through drawdowns and what it does to your account when you're risking, more than that 1 or 2%, maybe 5%, 10%, how many trades in a row you can have before you're ruined. It's important to know those things, and this is where back testing of something comes into play. But you're going to have periods with this or anything else that you do where you might have days in a row where you have loss, and then you start having a couple of wins that are back-to-back wins. As long as your wins are outweighing your losses, if you're looking at that 2-to-1 win ratio, win to risk ratio, or 3-to-1 even is better, that obviously stacks the deck in your favor for that long-term expectancy. All right, so there we have that. Let's pop back over here. Oil, oil on the 4-hour is still in an upward trend here, so oil is continuing to push higher. We did have some news yesterday, some forecasting that came out at the end of the day, and it might be coming back in today a little bit, just forecasting what the demand is going to be over the next few months and even a year. But oil seems to still be pushing up, so the 30-minute is in agreement with the 4-hour bias, so we continue to look for long trading opportunities. What does that mean to us? Well, we'd look for pullbacks is one way to look at it. Coming back to key areas, we've got a key area through here, 2580, certainly setting up as a top. It struggled, it was a top, and then finally break through, retested it once, retested it twice. 2580, 2550 areas down here, if it does pull back that far, to look for potential retests and see where it goes from there. Of course, we can also look at breakouts, or we can look for following on a pullback, following our potential entry points down at the tops of these previously closed candles. So like right now, we're in a long situation on oil. This last candle closed, so we potentially have an entry up here at 2620 and a stop loss down here at 25.90. So it's a bit of risk, quite a bit of risk, but you could look at that as a potential entry in style. Now you need to have a larger account in order to take that much risk, but just be prepared. You can go down to a shorter time frame and see what that looks like. But you could look at that and see if that's a potential for you. Now, if this candle closes and it hasn't popped back up to touch in, then we'd go down to the next candle and we'd look at the top of that with a stop loss down here to see what our next potential entry point would be. But we've got to wait until this candle closes in 2 minutes before we could make that determination. So, we've got 2 minutes for this candle to close. If this candle closes, let's say right here at 26, then our next entry point would be, at 26.02 with a stop loss down here at 25.69. Of course, we still got 2 minutes. It could suddenly shoot up. We don't know what's going to happen here. But once that candle closes, we could then make another decision, right? Make our next decision point as that candle finishes up what it's doing. So that's just another way to look at the market. Over here on gold, gold we mentioned yesterday had been caught in a bit of a channel. We talked about some key levels. Talked about 1700, being a big level for us. We've just been, bouncing off of 1700, 1705, top edge, bottom edge of that area. We talked about breakouts above 1750 and even above 1720 if we got that high. Certainly have pushed through there, and now we're seeing gold continuing longer. So back to the 4-hour bias is long on gold. If we go down to a 30-minute here, we're also long as well. So we'd continue to look for long trading opportunities on gold. Same exact process there. If we could look at either a pullback to the 1720, maybe even down to 1715 if we got that low, or we could look for trading opportunities where we break above key levels. So 1722 is a key level here. 1725 is more of our top level up here. So if we continue to see this rally, if we break above 1725, that could be a great entry point for us. Or, be patient depending on what your trading strategy is. If you'd like to if it's coming down like this, we continue to trail our entry point based on the top of those previously closed candles. Now, that's there it is. So I'm at 22.5 minutes right now. I think I'm gonna wrap it up here. The big takeaways, before you start trading, look at the time frames that make sense to you to judge your trading process on. Is that a 4-hour? And do you have bias? Are you going to form your long or short bias based on what time frames? 4-hour and 30-minute, or maybe a 30-minute and a 5, or 15 and a 1, or a 15 and a 5, or whatever it might be. Figure out what you're going to base your bias on. Draw your support or resistance areas, your levels, based on that higher time frame of the two. So if you're using maybe a 4-hour and you're going to trade on a 30-minute, base your key levels on the 4-hour time frame. So if you're going to trade on if you're using a 30-minute and a 5, draw your key levels based on the 30-minute, not on the 5-minute. Draw them based on the 30 minutes where you've got a little more, little more information behind you for that support or resistance levels, and then come into the day, right? Very, very, very important to plan your trade, plan your day before you're trading. If you've got something happening where you're going to have to run out, you're not going to be part of the market for a little while. You need to have a decision. How are you going to do that? Or are you going to put a trade on, or are you not going to do anything because you're going to be away from your desk? All things to think through and consider. So anyway, that's it for now. I'm going to let you guys go and get back to your days, and we'll see what the market brings us this morning. There's really no major news coming up. We do have kind of a medium impact employment claims report. Actually, that just came out. Employment claims report just came out, significantly higher than was expected. We had an expectation of 2.5 million, almost 3 million people on unemployment claims here. It's not decreasing, it's getting worse. That doesn't bode well for the economy. But don't trade what you think should happen, trade what is actually happening. We need to see how the market reacts to that. I know how I react to that. but the market doesn't always react in the same way. Of course, our biases are down on the 30 and on the 4 hours. So we'll see what occurs as we get into the trading day under regular trading hours here in about an hour. All right, so that's it.